Hi guys, welcome back to TipRanks. My name is Annika and here at TipRanks we love to hear from you. Let us know of different stocks you're looking at. Your opinions on market sentiment. Leave it down below in the comments. Welcome to the last month of 2021. In this video, we're going to look at two strong buy dividend stocks that give us a dividend yield of at least 7%. The market seems to be lacking direction with the new COVID-19 variant. And of course, this coupled with the Federal Reserve's announcement on elevated inflation is not helping. So it's kind of the time for defensive stocks that are short-term hedges in your investment portfolio. And there's no better way to do this than through dividend stocks. The first dividend stock is Enbridge, and its ticker is ENB. Enbridge is a $78 billion giant in the North American energy sector. It controls 20% of the US natural gas market, and it's also the largest natural gas distributor in Canada. So in total, its market share is an impressive 25% in North America. This makes it the third largest gas utility company on the continent. During the third quarter, Enbridge made a move to expand its overall position, especially in its position within the US Gulf Coast. It acquired a major crude oil export facility at Corpus Christi, Texas. The facility in question, formerly Ingleside Energy Center, now Enbridge Ingleside Energy Center, is the largest crude oil export terminal in North America, and it handles 25% of all Gulf Coast crude exports. Enbridge Ingleside Energy Center can store up to 15.6 million barrels of oil and can export up to 1.5 million barrels daily. Enbridge was actually paid $3 billion cash for the acquisition. The current price for Enbridge is $37.29, and the analyst rating consensus is a strong buy. The analyst price target on Enbridge is $45.15, which is a 21.08% upside. In the Q3 2021 financial results, a key point for investors is the 2.3 billion Canadian dollars in distributable cash flow. This is around $1.8 billion in US currency. This was up 9.5% from the year before. This is the metric that feeds the company's dividend, which is substantial. The ex-dividend date was on November 12, 2021, and the dividend amount per share was 65 cents, and this gives us a dividend yield of 7.98%. They have a 113.95% payout ratio, and the dividend growth has been for 2 years, which deems it to be a strong buy. As you can see, the dividends have grown. The TipRanks Smart Score is a 10 in that it is very likely to outperform the market. Analyst ratings deem it to be a strong buy, despite TipRanks investors being very negative. Blogger opinions and news sentiment is bullish, as well as hedge fund activity has increased. Technicals have been positive and insider activity has sold shares. But fundamentals show that there is a return on equity of 9.89%. Evercore analyst Todd Firestone gives it a price target of $55 and a buy. This is a 47.61% upside. And he says that there are a lot of things we like, but we think the most important is what Enbridge does better than anyone in the midstream space. They give detail on long-term capital deployment and attach a growth target with those outlays. He also said that, yes, there are near-term headwinds in narrow heavy diffs and FX impacts, but longer term we like the exposure to liquid pipes expansion potential, combined with a US gas business and wind and solar as less risky transition initiatives. We think that this is a better way to think about how to make money in what is going to be an oil demand growth backdrop for the foreseeable future. It provides better optionality and more downside protection in our view. The second dividend stock is Altria Group, and its ticker is MO. Altria Group is a well-known maker of e-cigarettes and cigarettes, including the brand Marlboro. A series of issues have faced the tobacco company in the past year. ranging from trade disruptions secondary to the COVID-19 pandemic to the underperformance of the company's large investment in brewing company AB InBev, to lawsuits and losses resulting from its purchase of the Juul smokeless electronic cigarettes and a patent dispute with the British American Tobacco. With all of these complications, Altria has some other issues which may require some explanation. Altria has held a 10% stake in AB InBev and until 2018 profited well from the brewer's high dividend. InBev has since then cut back on its dividend and now pays out 20% of its 2018 levels. The cuts came secondary to the company's deeply leveraged purchase of SAB Miller in 2016. After the SAB Miller acquisition, Altria's stake in BUD was subject to lockup restrictions which expired in October of this year. There was speculation that the tobacco company would divest itself of its underperforming brewer. But at the end of October, Altria announced that it would keep the BUD stake. The company actually reiterated its confidence in AB InBev's ability to meet its challenges based on a sound long-term strategy and premium gold brands. They have also been having e-cigarette issues, and this explains why they decided to keep the beer investment. Altria was long considered poised to dominate e-cigs, having the smokeless heated tobacco IQOS system and a 35% stake in Juul. But over the course of this year, Juul is being hit by lots of lawsuits, putting Altria in the way of a potential $13 billion hit. And worse so, the US International Trade Commission ruled that IQOS violated British American tobacco patents and must be removed from the shelves. So these developments could shut Altria out of the e-cigarette market for the moment. However, in their Q3 2021 results, their revenue growth was sound. It came in below the year-ago figure, but Altria reported a top line of $5.53 billion. This was only down marginally by 2.6%, while the EPS of $1.22 was up slightly, 2.5% from Q3 of 2020. The current price for Altria Group is $43.32. The analyst rating consensus is a strong buy, and the analyst price target is $53.88, which is a 24.43% upside. The next ex-dividend date was actually already gone in September 14, 2021, but the dividend amount per share was 90 cents, which gives us an 8.16% dividend yield and a 77.14% payout ratio. Dividend growth has been consistent for 13 years, as you can see. The TipRanks Smart Score deems it to be a 10 in that it is the most likely to outperform the market. Analyst ratings deem it to be a strong buy. TipRanks investors, however, are very negative. Blogger opinions are bullish. Hedge fund activity has also increased, but the technicals had been negative as we saw the revenue go down by 2.6%. Fundamentals, however, show that return on equity is a whopping 295.41%. It's important to note that Altria is maintaining its commitment to return profits to shareholders, expanding its share repurchase from $2 billion to $3.5 billion and bumping the common share dividend to 90 cents as we saw. At this rate, the dividend annualizes to $3.60 and gives a yield of 8.2%. The increase marked the 56th dividend raise for the company in the last 52 years. Not many dividend players can match this record. Jefferies analyst Owen Bennett is not certain that Altria will keep to its stated path in regard to beer and e-cigs. He writes that despite Altria Group outlining its commitment to ABI near-term at Q3, we believe it had to say this, and we aren't convinced Altria Group sees ABI as a better source of value creation. Strategically assuming a Juul PMTA, which we think is coming, Juul can see significant growth, especially under Altria Group's control and with traction internationally. Vapor is cannibalizing cigarettes, so added incentive to own all the economics, and having full control can boost ESG credentials. So guys, those are the two strong buy dividends that deliver a dividend yield of at least 7%. The market has been in the red recently, so dividend stocks are a great hedge against your investment portfolio. Leave your thoughts in the comments below about what you think is happening in the market, what your opinions are on the market sentiment, and what you think of these stocks and different stocks you've added to your portfolio. We love to hear from you. And if you made it this far, don't forget to hit that like button and that subscribe button and that bell notification so that you get informed on when the TipRanks channel releases a video. Remember, this is not financial advice. I'll see you guys in the next video. Bye!